What do you think what do you think is going on behind the scenes in some of these countries? What are they thinking about the current state of trust in the dollar?
Yeah, that's a fantastic question. I think they're at different levels depending on who they're allied with. So you see the BRICS nations they've come out and straight said it. We're going to create a global reserve currency to compete with the dollar. So you can't be any more clear than that. I mean, they literally have said that verbatim. So that brings us to a whole nother level with those countries. And this was really started by the United States weaponizing the dollar against Russia. Sent a tweet out earlier today where I said, unfortunately, it looks like the dollar's dying by a death by 1,000 cuts. And it's just so sad that the US government was the person who did the first couple of cuts, almost inviting everybody else in to come in and take their slice. Now, one thing you said about the other currencies relative to the dollar, this is really important because what happens is when you're the reserve asset of the globe, right? The entire economy of the world. What that does is it creates a huge base layer of demand. And this base layer of demand is necessary in order to keep positive price pressure on the dollar. And, you know, a lot of Bitcoiners get upset when I say this, but it's an economic reality. When you're the global reserve currency, your currency is deflationary. You know, so it's not the system itself. History needs to remember it's the politicians and bankers who yielded the system and corrupted the system in favor for themselves. And, you know, if you think about it, we are the savers. The savers are the lenders. The banks are the borrowers. The governments are the borrowers. So it becomes clear as day when you can look at the marketplace and say, well, wait a second. Debt used to be an asset for the lender, not the borrower, right? It was the person who was lending money who would get the yield. In today's world, in real terms, it's the person who's borrowing the money who gets the yield in the form of increased purchasing power. I said it like this in the previous show. I do believe in the future, people who have 30-year mortgages will one day be able to walk out into the street, pick the dollars up off the ground, and pay their mortgage. That's not an asset for the lender. That's a liability for the lender. And of course, they rigged the system like that because they're the borrowers and we, the people who are the savers, are the lenders. So that's the first problem. They've clearly rigged the system for themselves to empower those who are borrowing because they're borrowing way beyond. With fractional reserve banking, they're borrowing at 100x of the liquidity that savers can provide. And that's where we get the problems where we have today. But the second thing is as the world grows, as the rest of the world grows, and the demand on dollars grow, if the demand on dollars grow, but the supply stays the same, basic economic principles tell us the price of the dollar is going to go up. So being the world reserve currency, the United States had the privilege to be able to expand its currency supply and not cause inflation. But they had to expand the currency supply at a rate that matched the growth demand. So as long as they expanded the supply at a rate where demand was expanding, then supply-demand equilibrium remains the same. Therefore, the price remains the same. So this isn't about a flawed system. This is about flawed people who mismanaged the system and who abused the system and who corrupted the system to make it in favor of themselves, the borrower, instead of in favor of the savers. Bitcoin flips that script upside down and empowers the savers and makes those borrowers actually take risk. But the dollar, being in a position of dominance, is what allowed it to be created in order to match that demand without being inflationary. Now, obviously, the rate at which we're creating dollars, over 40% in the last 2 years, is far outpacing the growth in demand. And a lot of that has to come back with them not only corrupting the system and manipulating it to empower themselves, but now going into the academia and redefining inflation, redefining CPI by changing the equations, performing, what's the word I'm looking for? Performing
hedonics.
Hedonics and unhonest alterations in order to keep the trust of the people. Because the fact of the matter is when trust is lost, the dollar will hyperinflate. The only difference between inflation and hyperinflation is trust. And that's what's concerning to me because, like you said earlier, Where does the rest of the world line up with this? Obviously, the BRICS nations have lost trust. They are openly competing. Now, what about our allies? It's hard to say. The euro, they had negative interest rates. Now they're raising quick. Everybody is mimicking what the Fed is doing. And I think that's the biggest mistake that everybody is making. If we just do what the Fed does, then everything will be okay. Yeah, until it's not okay. And now it's not okay. So even these BRICS nations who are trying to come out and compete with the dollar, nothing can compete with Bitcoin. Nothing can compete with gold. Nothing can compete with silver. These are the three hardest monies in the world. Bitcoin being the number one hardest, obviously, with a finite supply. We can find more gold. We can find more silver. There are not going to be more than 21 million Bitcoin. So Bitcoin is the hardest money in the world. So now it's not that they're competing with the dollar, because the dollar's gone. We are watching the end of the currency life cycle with our own eyes. Now it's about Bitcoin, gold, and silver. They can't beat it. I think they understand that. And that's why this is a war of attrition. World War III is being fought in the financial markets, and they are slowly chipping away at dollar dominance, because it's not even about the price of the yuan against the dollar or the ruble against the dollar. What it's really about is getting the base layer of demand to shift away from the dollar and into other currencies. And as the supply of the dollar increases, but its demand decreases, that same economical principle tells us the price is going to go down significantly.
For sure. And we've talked on this show, and I'm sure you know this as well, the sort of petrodollar dynamics. If a country like India goes away from paying for oil and oil products in the US dollar, demand falls off a cliff, to your point, and changes that equilibrium. It's important to remember these things. I think a lot of people kind of get, I say this a lot about Bitcoiners, especially the new Bitcoiners, get kind of lost in memes and laser eyes. And it's important to know that there's a lot going on besides the memes and laser eyes. The memes and laser eyes are good, but there's other stuff going on that's important that will help you kind of spread the message. Now, I'm going to ask you a question about something you mentioned there. Trust in the US dollar, and trust being the difference between inflation and hyperinflation. Don't you think that it's fair to say we haven't had trust in the US dollar in 30 years, basically since the sort of retail stock market was available to the average Joe and average Jane? No one really saves in cash. And so I'm wondering, what is the line for you between trust and not trusting it? Because in my view, we're already there, and we haven't quite seen hyperinflation. I know this is kind of a foggy term and difficult to define. And as you mentioned, the definition is more fluid than it should be at the moment. But what is your view on that? Didn't we already lose trust in the dollar, or am I missing something there?
Yeah. So a couple things. First thing is petrodollar demand is obviously large, but it's small in comparison to the euro dollar market. And when I say euro dollars, I'm not talking about the euro. I'm talking about the dollars that are created by foreign banks, because it's not only American banks that have the ability to extend dollar denominated credit. Foreign banks can extend dollar denominated credit as well. And the euro market for dollars is much larger than pretty much any other market. It has its separate yield curve and everything. The Fed is currently wrestling with that. So a lot of that demand is based off of foreign entities who own US assets and therefore receive cash flow in dollars, but then they have to bring that cash flow back to their country and change it back into their own currency. So if the dollar is gaining against their currency, that's fine. They're increasing their purchasing power. But if the dollar is losing against their home currency, then they're actually losing purchasing power. So there's literally a whole bunch of leveraged hedges to the tune of 1,000 trillion plus of all these entities, foreign entities that own cash producing assets that produce dollar cash flow, that are hedging the value of their dollar against their own native currency. So a lot of this demand, a lot of this trust, it's created by these financial tools that exist. It's a way that somebody can become delta neutral. In other words, if you have a position and it's delta neutral, it doesn't matter if the price of that asset goes up or down. The value of your portfolio is going to stay the same, right? It's like owning spot Bitcoin and being short 1x. If spot goes up 10%, you're up 10%, but your short's down 10%. So push comes to shove, your position is still even. So yeah, you're right. There is a lack of trust, but it's more so based because of there's all these different financial tools and products that exist in order for these entities to hedge against these different movements of the dollars. Now, that's on a sovereign level and a corporate institutional level. On a personal level, that's where I think the trust is going faster, because people never realized that it wasn't okay to save in treasuries. You know, very wealthy people, especially old money who have old businesses with cash flows, they don't even pay attention to those things, right? They're too worried about doing whatever social thing they're involved with. Most of them aren't involved in the day-to-day management of that money. They have financial managers, family offices, hedge funds. They're just making sure that the number goes up and it doesn't go down too much. And that's really all they care about. They put their time and energy and effort in other things. For the first time in a long time, we're starting to see those people ask questions like, hey, my business had a 10-year plan. We were supposed to break ground and build 3 factories because we stored $100 million in treasuries and we did it in 10-year notes. Well, here we are now 10 years later, and you're telling me that I can barely afford to build 1 factory? What happened? That doesn't make any sense. We were supposed to build 3. Now we can only build 1. So the massive dilution of the dollar is now waking up a whole class and genre of people who at one point didn't care, to now start to ask the question, say, what the hell is going on here? You know, at what level does this dilution need to be taking place in order for this to go from 3 factories to 1? Is this something I'm concerned about? I thought we were hedged, and now all of a sudden I'm getting 66% less than what I was supposed to get. And when the United States puts people in that position, and not only just people and companies and sovereigns themselves, but pretty much the whole world, in that this is the result that you get. It's death by 1,000 cuts, and we've done the first few cuts ourselves. So trust is on the brink. And just one more thing to add right there on the mathematical definition of hyperinflation, because you're right, it is hard to pinpoint where this happens. But with the case studies that I've looked at, there is no mathematical point at which hyperinflation starts. Sure, the textbook will tell you, hey, 50% per month is hyperinflation. But, you know, maybe that's with a society who doesn't really understand that much about money. In a money-centric society, or I should say in a currency-centric society like the United States, maybe it's 20%. We don't know what that catalyst is going to be, where that trust is going to be lost. But one thing's for sure, you can print more or you can print less. But if you don't have trust, you can't print anything. So for me, the best definition of hyperinflation is the loss of trust, because that is honestly what gets the velocity of the money to increase, the amount of times that those dollars start to change hands, because nobody wants to hold on to them, starts to increase significantly. And that's what we're seeing now today.